Welcome back. You're still watching Crystal Ball. I've been in conversation with Madhu Kela of Reliance Capital. Madhu, you were speaking about IT before the break. What about telecom? I mean, that's top of mind for everybody right now. What does one do with the sector, with stocks like Bharti, Idea now, which seem under such a lot of threat because of the entry of a very, very aggressive player?
So I think it's still, in our mind, it's still wait and watch. Then we have to see the whole rollout of Jio. The plans are very, very aggressive. And let's see how the commercial launch happens, what kind of subscriber numbers do they get. And I think one will have to evaluate post that only, because this is unprecedented. I think this level and this scale of launch has not happened, at least in India I have not seen. So I would still wait and watch in this sector.
Do you think the days of serious wealth creation as a sector is in the past for a sector like telecom? I mean, the money which people had to make, they probably made a few years back. Now it's no longer going to regain that kind of position? Yeah, that I think you can bet, because if at all, the intensity of competition is going to only increase, and it is going to be very, very high. You have not yet seen what Bharti and Idea and Vodafone will do in terms of counter offers. But to say the least, they would like to protect their customer base. They would like to protect, whatever market share they have, which effectively will mean that they will have to also do aggressive pricing than where they are today. Which conversely means that obviously there is the near-term earning, next 1-2 year earning might be under threat. So it will be interesting to watch where this, the pricing battle, where does this, the competitive pricing settles down. And which is why I am saying that, whatever wealth which had to be created, the big wealth creation, maybe in the past, for 1-2 years looks very, very competitive and extremely challenging from an earning perspective for this sector. Okay, let me ask you a question about the sector that you come from, NBFCs. I mean, that's been a star sector. Now, do you have the courage to go out and buy these stocks at these kind of price-to-book multiples?
Yeah, selectively not. But will I say that for the entire sector? The answer is no. But will I say that the entire sector is a buy? The answer is no, either way. So I'm just saying that, you have to be very cautious what you're buying in NBFC, because the fundamental thesis of consumer credit, of housing finance, of the cost going down for these companies, the cost-to-income ratio going down, it still stands. So, obviously, you see, in the last 2 years back, within the overall NBFC sector was roughly 5 lakh crores. Today, it is roughly 8 lakh crores. So, a lot of value has got created over the last 2 years. Valuations are not as comfortable as they were 2 years back. But will it mean it is a complete sell? No. You can still find select pockets of good investment in the NBFC space. It's not a sector buy as a whole. But you can still find companies. But obviously, you can't buy an NBFC company keeping 3-6 months period for appreciation. You will have to have at least 2-3 year time frame to make return. But I would completely agree with you that the time is there for caution in some stocks which are like trading at very, very high multiples, whether it is price to earning or price to book. And I would not hesitate even to book profits in these companies if one is holding stocks in their portfolio. Now, going by my past experience, one must remember, as when we buy stocks, the prices come down. So when we sell stocks, the prices can go up. But that should not deviate a fundamental investor, that if you are selling something at 7 times, 8 times, 9 times book value, and if it goes because of the liquidity scenario, because of the news flow, it goes another 20%. One should not feel nervous. So this advice is not for investors who will feel very nervous that I sold out and I have left out, Because in this kind of thing, you can never pinpoint that this is the bottom or this is the top. But some select NBFCs look very expensive. There is no doubt about it.
It's an excellent point you make, because that was my next question about mid-caps in general, not NBFCs. How do you approach investing now? Because even for very experienced investors who own good quality mid-caps, now they have this curious situation where they might have set a price target which has been crossed by 20%, and they can still see a lot of momentum in the stock prices, but when they sit down and do valuations, they say, I can't justify these valuations because my targets have been well crossed. what's the right way to approach mid-cap investing in such a liquidity scenario where prices are arriving and crossing your targets very easily?
Then I think, if you're a long-term investor, we have seen many cycles of this bull and bear phases. That, when we buy a particular company at 100 rupees, and if you think this is a deep value, the stock goes to 80 rupees and 70 rupees, you keep scratching your head that, you did all your work, the prices have still come down. The same situation in this kind of a scenario when you do your homework and say this is what my target price is and the target price has crossed by 20%. What do? Do you go all out and sell everything and sit on cash? The answer is no, because some of these businesses, as I explained to you, it is not only the usual metrics which you are trading in this kind of market, which is price to earning and price to book. Given the liquidity situation, that the price target could always cross 15-20%, given India interest, given the local interest to put more money. So I would not sell anything in a hurry just because my price target has exceeded by 20%, or just because the company is more expensive by 15-20% than what I think normally the valuation should be. And I will tell you, then, in 2000 I learned this lesson. I personally held some Satyam Computer shares, and someone explained to me that's not later on, whatever the story turned out. But, after I sold my share, the stock price went up 10 times in matter of 10 months. 10 or 12 months. So, in this kind of bull phase, if you are purely operating out of valuation and if you take a call, specifically if you are a fund manager like us, then there could be a lot of pain, So I would not suggest that if you are holding very solid businesses, unless and until it has become really exorbitant, it is not 10-20%, but you feel valuations have become 2 or 3 times than what you think normally the valuation should be, then obviously it is a call to sell. But I would not worry about this 10-20% kind of issue. I would still hold on to the portfolio of good companies, good businesses, because there is no doubt about it that we are in the midst of a really big bull run. And in the bull run, if you get out, it's so difficult to get in again.
At what point do you start worrying though, Madhu? I mean, I take everything that you said, and we are in that kind of a scenario right now. But sometimes you get the feeling that there is a bit of irrationality which is creeping into the market, all things considered about the constructs which are there globally. And then sometimes you start to take bets against the market to protect your portfolio. When, to your mind, would such a scenario come about where you would start to say, okay, enough is enough, I know things are very rosy, but I don't want to get carried away?
But I'm saying, Udayan, for India's story as a whole, that scenario is not there today. But for select companies and select sectors, as we discussed, that scenario is even there today. So we are, I would not hesitate in selling something which is really looking exorbitantly more expensive to me, that even in a 2-3 year time frame, if I construct my earning, I am still not comfortable buying those companies. But at the same time, there are a lot of good buy ideas. And for instance, those buy ideas, even though I am a big mid-cap fan, those buy ideas could be in large-cap companies, for all we know. So you have to keep an open mind at this point of time, because if you set in that bias that markets are expensive, then you may end up selling a lot of things, And if you get out in the midst of this kind of a bull run, then what I'm only saying is it's so difficult to get in again. So you have to keep doing your homework, and we are still finding good ideas, we are still finding good businesses, we are still finding good companies which are reasonably valued, even to invest in these kind of scenarios. Like, let me just talk about 1 or 2 sectors, like travel and tourism. I think we have spoken about this consumption theme in India, and if I look at the kind of opportunity which is there, the push which this government is giving, and with rising incomes of Indians, I think over the next 3-5 year time frame, some of these companies can offer excellent investment opportunity. Now it is, again, I'm not a sector fan, so I will not invest in the sector. But within that sector, will I find great companies to invest in? The answer is yes.
When you say travel and tourism, I know you don't want to talk stocks, but are you talking about hotel companies or other facilitators in the chain?
Portal companies, facilitators are in the chain, people who are kind of vendors to this industry. I think you will find, plethora of companies. And, what is interesting, Udayan, a lot of these new companies and new businesses will also get listed. And as long as they get listed at reasonable valuation, you have to keep an eye. I just said as a theme, liquor again as a theme, because it is completely out of fashion. But in a mid to long term, will liquor die in India? The answer is absolute no. So I am saying there are still select pockets. If you are sensible investors, you should be evaluating these things who are out of flavors, who are not really fancied by the markets, and that is where traditionally we have seen the returns are.
Just one quick point I want to make about this infrastructure sector, because we're still not seeing the revival of the private capex cycle. I mean, the stock market is on a bull run, but somehow you're not getting the revival which one would have thought you would see the first signs of by now. What is your expectation? I mean, of course, on the margin good things are happening, like this arbitration payments to construction companies or contracting companies, but that overall impetus from one big leg of the market is still not coming.
Yeah, the investment impetus is not there, and then it doesn't look like that it is, till the time the balance sheets are repaired and people are able to raise fresh equity. I don't see the private capex coming in a hurry. I would still put at least 12-18 months time frame for the kind of revival which you are talking about to come by. By then maybe liquidity situation in India is strong. A lot of global players would have come and bought assets. So that one leg of the market doesn't look like that it is coming back in a hurry. But again, the space which you mentioned, but are there select opportunities, because these are the sectors which are out of favors. So there will be a select opportunities to invest. And if you have a time frame of 3-5 years, then there is money to be made in those kind of sectors. Even, for instance, you talk about public sector bank. My own gut is that in 2018-19, all these provisions which you are talking about, you could have a scenario in some public sector bank, there could be write back. Now, and I dare say this because this is not a consensus view. This is not what the analysts are saying today. But I think there is a possibility that if the GDP continues to grow at 8% and 2018-19 being an election year, the entire push might come from the government side. So you might have even a lot of value in select public sector banks.
Madhu, always a pleasure talking to you. Thank you very much for your time today.
Yeah. Thanks a lot, Udayan. Thank you very much.